And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to Tuesday. It's also the best day of the week because it's the last live show this week. Yep, holidays are starting for us tomorrow. We'll be back Monday live right here on the show, but John will be joining me this morning. But don't worry, we've got content set up for you for the next 3 days. Simply go to our website, realinvestmentadvice.com, click on the resources tab, and check out our podcast. You know, we do stream live here on YouTube, but we also stream on podcasts, your favorite Apple, iTunes, or SoundCloud, or Spotify. You'll find shows there for you for the next 3 days as well over the holidays. But want to wish you a very happy Thanksgiving holiday, and of course, spend time with your family and enjoy that time together as always. And also give thanks for the turkey who is giving up his life for your celebration. He is committed to the cause. Absolutely, Brent. And don't forget those potatoes. Then they're in there. So, but anyway, so yeah, enjoy your Thanksgiving holiday with your family. We'll be back next week. Not a lot going to be happening tomorrow. Tomorrow's a very light trading day, obviously, because it is the day before holiday. Generally, the markets rise into Thanksgiving. And again, we saw this a little bit yesterday. We'll talk about where we are. But Thursday, markets are closed. Friday, markets are only open half a day. So we'll have a little bit of trading on Friday. Often get this question, why don't the markets just close Thursday and Friday, right? Anybody ever wondered that? It's because there is a law that says banks cannot be closed more than 3 days in a row. So you can't be closed on Thursday, Friday, Saturday, Sunday, because that's 4 days for banks to be closed, and you can't do that. So that's why we're open half a day on Friday. So outside of that, economic data continues to come in okay. We had the New York, recently we had the New York Fed index. We had the Dallas Fed index yesterday. They're all showing signs of improvement, and in particular, these are surveys, mind you. So these are sentiment-driven surveys. It's how do you feel about things? Do you feel your orders are getting better? Do you feel, how do you feel about, hiring people, those type of things? So it's a how do you feel type survey. Since the election, we've seen very sharp increases in outlook for hiring, for better orders, those type of things. It doesn't mean that's necessarily going to mature, but these regional indexes are starting to show a lot of optimism about the recent election of President Trump, coming from fairly low levels, starting to jump up back towards expansion territory. So that's good. That's giving a little bit of support to the markets. We're going to get some PCE data out here shortly. Next week, we're going to start getting into the employment report. I believe it's next Friday is the employment report. So we're about to get a big chunk of economic data that'll be moving markets, particularly yields, as we start moving towards the Fed meeting on December the 18th. And right now, it's still expected the Fed will cut rates by 25 basis points in December. And then they've got, right now they're estimating about 90 basis points of cuts next year. So that's about 3.5 cuts next year. So we'll see how that kind of migrates next year. But again, expecting a slower pace of rate cuts next year as long as the economy is kind of holding in there. So this is going to be a very slow rate cutting cycle, and unless we start getting into either Treasury market congestion because of debt issuance, or if there's a more severe economic slowdown, or as I talked about yesterday, I interviewed with Charles Payne on Fox Business, and we were talking about the one big risk for 2025, and that really is a big reduction in government spending. So we talked yesterday about Treasury Secretary Bessent and, of course, the Department of Government Efficiency all looking at trying to cut government spending, and of course that feeds directly into corporate profitability. So that's kind of the big risk for 2025. We'll be watching closely. That'll have a big impact on what the Fed does as well as what the bond market does as well next year. So here's what you need to know before the bell this morning. Yesterday we had said that, hey, the market's going to try to run to 6,000 here, probably in the next day or so, and we actually hit 6,000 yesterday morning. Bounced off that a little bit. Initially went above 6,000 for about a brief moment. Then tailored back off, went down, pretty decently, almost unchanged, and rallied back towards the end of the day a bit. Finished at basically 59.70. So we're right there, just kind of knocking on the door of the of 6,000 this morning. The Dow's opening down about 70 points, kind of flat on the markets this morning. So again, we may see a little bit of a weak opening this morning and then a bit of a rally into the afternoon. Wouldn't be surprising. I think we're going to continue to try to bounce off that 6,000 level here. The markets are going to try to break through that either today or tomorrow. So I would not be surprised that today or tomorrow we close above 6,000. And if not by Wednesday, on Friday for sure. There's just this kind of magical thing. The market, as we said yesterday, the market loves these big round numbers. So there's going to be this push to really kind of get through that level. And we could see that today if tomorrow, wouldn't be surprising. Again, we're coming back up on a buy signal, so that's going to give a little bit of lift here to the markets as well to try to do that. But again, we're not grossly overbought, but we're starting to move up in that direction. So again, not too much to worry about here. Yesterday, of course, we had a big move in Treasury yields because of the news about the Treasury, Scott Bessent, the Treasury Secretary nominee. He's very much a fiscal hawk, and that was a very good kind of move for the bond market. Importantly, we kind of bounced right off that resistance level at 4.5%, which is kind of in the long-term downtrend now that we're seeing starting to form within bond yields themselves. In fact, if we kind of just look back here, we've got this kind of declining trend line of these peaks. So again, we're getting lower highs and we're starting to build a period of lower lows. So again, the market's going to try to move this back down. And again, next year as we get into more slower economic growth, further rate cuts from the Fed, and again, if kind of expectations are what they are, yields should continue to kind of decline here back towards at least 3.5, 3.8% would be an unsurprising target for some time next year. And again, that's kind of where the expectation is right now for the market overall as well. The other big one yesterday, of course, was gold prices. Gold has had a really great run this year, but starting to set up a little bit of a pattern here. You've got a top, kind of a double top here getting built, and then you're starting to build kind of the formation of a head and shoulders pattern. So that's going to bring in this 25.65 level as real kind of critical support. We take out that 100-day moving average. You're also going to start to take out the neckline on a potential head and shoulders pattern, which would suggest lower prices in gold. That would kind of correspond also with a decline in yields, more strength in the dollar as well. So again, we'll kind of watch that very closely. Again, nothing really concerning here right now. It's more of a consolidation, but just kind of watch that 100-day moving average. That's going to be real critical support. That's where all the algos are kind of lined up right now for the market. So again, if you kind of break that level, that's going to bring in more sellers very quickly. Again, there's nothing wrong with what's going on. You've had this huge run in gold this year. It's been great. You've got this sideways consolidation. That's bullish. So as long as we can consolidate here, work off this overbought condition, and then start to continue to maintain that support at the 100-day moving average, that should give you a good setup for a rally into next year. But again, just kind of watch, that 100-day moving average. That's going to be kind of your key support, at least here in the near term. Outside of that, the rest of the markets are holding up well. Mid caps had a huge rally yesterday, moving up to the highest level we've seen since 2021. And that's right. In small and mid caps, while the rest of the world is making new highs, small and mid caps are just getting back to where they were in 2021. But we're almost there to new highs. We'll see if that happens here soon. But that's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn. Got to talk about the most important indicator today. If you're worried about a market crash, I've got the one indicator you need to watch. We'll talk about that next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. John Penn joining me a little bit. Morning, how are you?
Good.
Ready for Thanksgiving?
I'm ready.
Awesome.
How about y'all?
Yeah, I was talking about this yesterday. We've got like 30 people coming to our house.
You were the host.
I am the host.
The
this
chaos
year,
is coming to you.
Yeah.
All right.
So it's going to be interesting. We've been spending the last few days got to get everything. But this is my wife's sweet spot, right? I mean, she loves to bake and cook and host and do all that type of stuff. So this is her time of the year. So she's been decorating. And one of the funniest things this week was watching my wife put up the Christmas tree. So she's putting up and so this is one of those Christmas trees she bought, and it's got the snow on it already, and it's already got the lights. So all you got to do is just put it together and plug it in. Well, the problem is that in when we were renting our house previously, it had a real short ceiling. So she could only put up 3 sections of it. Well, the thing's all kind of pre-connected. So all you do is just stick them together and then plug in each section. Well, she had to unplug it to just put 3 of the 4 sections together to make it fit in the old rental property. Well, she forgot what went where.
Oh, no.
So she spent... So I'm watching her, and she's like, I don't want any help. I'm like, you sure you don't want some help? She's like, I don't want any help. And I'm trying to watch her get this thing put together. It took her like 4 hours to figure this thing out, but she finally got it done.
It's like a Rubik's Cube, man.
It was absolutely hysterical, but it's a beautiful tree. She decorates a great tree, and so it's in the front of our house, and she's very proud of it. But that was a labor of love, and she was not going to give up on that tree until it was done.
It was her or the tree,
and
she was going to win.
That was it.
Yep.
That was it. Mm-hmm. So anyway, yeah, Thanksgiving. Can't wait. All right, so I know a lot of y'all are regularly concerned about crashes. I get the emails, I get the comments in the chat, I get mental telepathy from you people. But seriously, there's a lot of headline. I get lots of emails from you, and I certainly appreciate them all. I try to answer them all, and there's a lot of videos and people out there right now saying, "Oh, crash is coming," and because the market's been up 20% 2 years in a row, crash has got to come, right? And there was a great kind of a great chart out this morning. Let me see if I can find it on X here for you real quick, because I think this really kind of brings it together. Just one second, bear with me. But this was a chart that was, here it is. So here was a chart that was posted out this morning, and then the chart itself will elicit the concern, right? Because the headline says the S&P's rise this year has been one of the strongest since 1928. Well, of course, everybody remembers what happens in 1929. Actually, that's a lie. Nobody remembers what happened in 29 because y'all weren't around. But we know history, right? And of course, that was where the peak of the market was. So when you see these types of charts, immediately that concern is like, oh, well, this has happened. And another kind of stat for you right now is that the S&P has returned 24% in a row, 2 years in a row. That's only happened 4 times in history. So immediately everybody goes, oh, well, that means a crash came right after that. Well, not necessarily. Actually, historically, the average return of the third year following a 20-plus year up year was about 12%. Now, there was a couple of years in there where you did have declines, but out of the 4 periods, you had a 12% return on average. So it doesn't mean that markets have to crash. But let's just assume you're concerned about it. So this is what today's article is about. I've talked about this before on the show, but talking about, look, if there's one indicator you need to be watching, it's credit spreads. Don't worry about the technicals. Don't worry about, the headlines and, people running around going, oh, a crash is coming because of, NATO or the dollar or whatever it is. That's not what predicts crashes, right? Those are events. And we tie events to why markets crash, right? So the markets go down, and we say, well, why did it go down? Well, we have to give it an event. So we have to rationally try to go find something. But that's not how markets work. If you really want to understand what causes a market crash, it's stress, and typically in the credit market. So that's why credit spreads are very, very important to watch. So one of the credit spreads, there's 2 in particular we're going to talk about today. Is we're relating everything from risk to risk-free, because that's what you need to know. What's the difference between the risk I'm taking today versus being risk-free? So I want to be risk-free. I buy a U.S. Treasury bond. Those are considered risk-free returns because the Treasury bond will always get paid off. It will always mature. My risk is in other types of bonds, corporate bonds, muni bonds, private credit. There's a ton of it out there today. But those all run the risk of default. So the question is are you getting compensated for the risk you're taking of something defaulting on you, right? So I buy a corporate bond, company goes out of business, I lose all my money, right? That's why you get paid a higher rate for corporate bonds than you do Treasury bonds, typically. So if we take a look, for instance, at the difference between investment grade. So investment grade bonds are corporate bonds that are BBB rated or better. So this is your Apples, your Googles, your Microsofts, your Metas, those your Exxon Mobils. Those are your investment grade bonds, BBB rated, A rated, AA rated, AAA rated. I don't think there's any AAA rated corporates anymore. But you're going to compare that because you have risk. Google could go out of business versus a risk-free rate. You should get paid more to own a corporate bond with default risk than a Treasury bond. But today, that's not the case. You are not being compensated for the risk. So when you are not getting compensated for that risk you're taking, that means there's a lot of confidence in the markets. When the credit market starts to realize risk, those spreads will widen. And when those spreads widen, that's when your risk of an event occurring in the financial markets increases. And you'll notice that, so and I know if you're listening in your car, I'll explain this, but if you're watching our video, you'll see it in the chart. Whenever credit spreads start to rise sharply, the annual rate of change in the financial markets decline. So if you're worried about a crash, those relate to increases in credit spreads. But this is investment grade versus the Treasury yield. So this is investment grade bonds, which are generally considered lower risk. You have risk, but lower risk than you do with risk-free treasuries. Okay. Now, all of this we go into detail in the article. So the article's on the website if you want to go look at the all the graphs yourself and go. We've got a lot of explanation about how all this works, why it works, and I won't go through all of it today because the article's on the website, realinvestmentadvice.com. But, Brent, I forgot to link that chart. Can you zoom in on that for me? So this was a chart put out by Carson Research. And again, this is kind of comes to that point about markets. And bull markets tend to last somewhere between 4 and 5 years, a little bit more, about 5.5 years on average. And there are certainly periods where we've had 2-year bull markets and then you had a crash. So for instance, or a correction, I shouldn't say a crash because crashes, insinuate, major events like the 1974 market crash or the 2008 crash. But bull markets tend to last on average about 5.5 years. But there are periods, 1966, 1970, 2020, 2022, where we had 2-year bull markets, and then you basically had a correction or a pullback of 20% or more. And that's the defining measure that they used at Carson Research. So a decline of 20% of the market negated the previous bull market and then started a new one. So we're about 25 months into this current bull market. Now, historically, I know there's a lot of concern, a lot of speculation in the markets right now. Market crashing and coming. It could. I mean, there have been periods previously, not many, but there have been periods where a 2-year bull market exists and then you have a correction. But how do we know that? And this is the whole point. How do we know that we're just in a 2-year bull market and the next year is going to be this correction or this crash? Because that's the worry, right? This is all the emails I'm getting. Oh, a crash is coming, a crash is coming, crash is coming. But this is the problem, right? We could be into a stretch of a 5-year bull market, right? And so what credit spreads tell us? They tell us 3 things, and this is why we pay such close attention to it. They tell us about corporate financial health, right? What is the market ultimately? The market is a bunch of people buying stocks in companies. And as long as the corporate health, their earnings growth, their corporate profitability, et cetera, is good, there's no reason why investors should not want to own them. Credit spreads will tell us about the corporate health. Remember, bonds are all about fundamentals. Investing in stocks is all about sentiment. I'm bullish, I'm bearish, whatever it is. But when it comes to the bond market, it's all about fundamentals. So credit spreads tell us about the corporate health. They tell us about shifts in risk sentiment. If the credit market becomes concerned that Google, Apple, Meta, Snowflake, Palantir, these companies can't pay their debt, those interest rates are going to start going up for those companies. They're going to say, yeah, I'll buy your bond, but you're going to have to pay more. It's going to cost you more in terms of yield. So what the yields tell you is shifts in sentiment about the risk in the bond market. And lastly, tell you a tremendous amount about liquidity in the market. Yields will go up when liquidity declines. So when we come back, I'm going to wrap this up and we'll get to John Penn because he's got some comments on this as well because he's running into this with a lot of clients. We'll talk about the most important indicator right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My son, Thomas, who really good-looking kid. And so he's starting a business for Thanksgiving to provide Thanksgiving packages.
The Real Investment Show
For
podcast.
$75, he'll show up at Thanksgiving, with a girl and tell a cute story of how they met. They'll stay through dinner and then, give the parents a hug on the way out.
Same show, your schedule.
Quite a business idea. I wonder if there's a package in there where he wears the matching ugly Christmas sweater.
At realinvestmentadvice.com.
No,
to the
that's
family, too.
the Christmas package.
That's the Christmas
That's
deal.
coming up.
Okay,
So
got it.
yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Okay, I want to wrap this conversation up on credit spreads, and I want to talk real quickly about the most important indicator to watch when it comes to credit spreads, and that is high yield bonds, quote unquote junk bonds, versus Treasury yields. So high yield bonds, double B or worse, right? So you look at double B credits, triple C credits, etc. Those are companies on the verge of bankruptcy. Yes, we market those as high yield because we want you to buy them, but these are companies on the verge of bankruptcy. And you should be compensated more for buying a company on the verge of bankruptcy than not, right? They have a very high risk of default. So your interest rate shouldn't be 4%. It should be something like 8%. That's not the case currently. You are not getting compensated for the risk of buying junk bonds. So why do people buy junk bonds? Because they are a risk proxy. If I want to invest in the stock market, but I'm a bond market investor, I buy junk bonds because I get basically kind of S&P returns, theoretically, buying junk bonds. I get more capital appreciation because there's a lot of flow into buying those bonds. But right now, Brent, you can bring this chart up for me. But right now, there is absolutely no risk premium in that spread for buying junk bonds. When that changes, and the junk bond to risk-free bond spread has been a great indicator going back since the century. I could go back further in time, but the chart gets too convoluted. This is easier to understand. But when that spread starts to rise, that has been a really good early warning indicator about wanting the need to start reducing exposure to the financial markets. For instance, in the dot-com crash, spreads were starting to rise in 1997, 1998. Now, you were like, if you would have gotten out of the market, you would have missed a big run in 1999, right? But you would have avoided the dot-com crash in 2000 that took away 50% of your money. Same thing in 2007. Credit spreads started to rise in 2007. It's Goldilocks economy. Everything's fine. Absolutely no concern about a market. Ben Bernanke's cutting rates and talking about how their subprime's contained. 2008, financial crisis. Same thing with in 2015. You started having spread rising. You had two 20% drawdowns in late 2015, early 2016. 2018, you had that increase in rates, and you had the decline in 2018. And then again in 2019, you had spreads going up. We were writing articles about the spreads increasing and the risk in the markets, and everything's fine. And then you had the COVID crisis in March of 2020. So again, these have been really, really good early warning indicators for market crashes throughout history. 2022, same way. Right now, if you're worried about a crash, there's no evidence of a crash on the horizon. Markets are fine. Sentiment, risk-taking, extremely bullish. When this starts to change, A, we'll let you know, but B, that's when you want to start becoming more conservative. But the time is not now. There's no concern right now of a market crash in relation to credit spreads. And so if that starts to widen, right, we'll tell you. And that's when you want to start reducing exposure to high-risk assets, increase your exposure to defensive assets, you review your liquidity needs. And this is what John does on a regular basis with financial planning, is reviewing those liquidity needs. Hey, if there's risk in the markets becoming more prevalent and you've got a liquidity need, you want to buy a house, buy a car, take a vacation, you've got, guaranteed monthly income needs, that's where you start setting aside that capital for the year so we can navigate whatever risk there is that's coming in the markets.
That's right. Yeah, it's, we're talking about high yield bonds a little bit. Kind of how I think about this too. I mean, you go back and you look at how the markets behaved in Q1 of 2020 when we were going into shutdown mode. You looked at how the Standard & Poor's 500 index behaved. You looked at how the NASDAQ behaved, at that sharp pull down. I mean, high yield bond prices were right there, almost lockstep. I mean, they pulled down dramatically along with equities. So to your point, Lance, high yield bonds, the prices of high yield bonds can act very equity-like. And just this whole topic around credit spreads, here's how I think about this with my simple mind. And if I'm wrong, tell me in front of everybody. I'm fine with it. But here's how I think about it too, especially so if let's say we all of us in here own high yield bonds.
Sure.
So I know I'm taking some risk by owning this high yield bond. I know this company is on the verge of maybe going out of business, going into default. But I like the high coupon. I like the yield. I want it. Well, if I sniff or if I have any sense as a holder of that high yield bond that the company that is issuing that debt is in trouble or about to be in trouble, what am I going to do as an investor?
Sell the bond.
I'm going to sell that bond. Well, then what are you going to do?
You're going to sell my bond.
You're going to sell your bond. What's Brent going to do? He's going to sell his bond.
So who's buying?
So that's right. So there's a lot of selling pressure. So prices of those bonds start to go down. Remember, bond prices and the yields of those bonds, they move in opposite directions. So you start selling these bonds down, the yield on those high yield bonds start to appreciate. Well, then if I'm looking for safety, I'm going to go buy treasuries. So I'm going to buy treasury bonds. Well, those treasury bonds go up, but then the yields start to go down. So that's, to me, you've got that widening credit spread between yields between high yield bonds and treasuries. That's how I kind of think about it too.
And that's exactly the right way, because all you're doing is you're going risk on to risk off.
That's it.
Right?
Right.
And that's what ultimately happens. And that's why, again, the thing that investors tend to miss is they get all wrapped up in these headlines. All right, World War III, or the debt, the deficit. We're issuing all this debt. It's going to be a problem. Those are just headlines, right? What drives market prices is shifts in sentiment, buyers versus sellers. To John's point, it's risk on versus risk off. Right now, it's risk on. There is nothing in the markets fundamentally that's suggesting to be risk off. And yes, we have all these headlines running around. They could all certainly evolve into something, right? But the bond market, remember, the most important thing is that the bond market is solely based on fundamentals. Why? Because if I'm going to loan money to John comes to me and says, Lance, I want to borrow some money. I go, great. What are you going to use it for? I'm going to buy a house with it. Whatever, right? Doesn't matter. I'll say, okay, yeah, I'll loan you money. So John's a good credit. I'll loan him money. So he gets a bit of a bonus for being a good credit. I know John will pay me back no matter what because I know where he lives.
Yeah, he'll find me.
Yeah. So he gets a little bit of a bonus, right? So I'm not going to charge him a tick for being a bad credit risk. But if he was a bad credit risk like Brent, I would immediately tack on an extra point. So let's say that the going Treasury rate is 4%, just easy numbers, right? John's a good credit, so I'm going to start out at 4. He'll pay me back. I'm in pretty good shape. But again, there's still risk there, so I'm going to charge him 4.5% versus 4 in a Treasury. Then I've got to adjust for inflation. What do I think inflation is going to be in the next year, 2 years? I think inflation is probably going to be around 2.5%. So I'm okay at 4.5%, so I don't need a big push on the inflation uptick. Take a look at opportunity risk. Could I invest somewhere better than John? And yeah, I could invest in a corporate bond and I wouldn't have as much personal risk as John. So I'm going to charge John an extra 0.5% for personal risk, right? So he's now at 5, bond market's at 4. So I'll go through all these risks. And that's all the bond market does. It's all priced on risk because I'm going to set myself at a particular rate with John for 5 years, 10 years, whatever the length of the term is. I need to make sure I'm adequately compensated for that capital versus what I could do with it elsewhere in the markets. Invest in stocks, bonds, whatever it is. So, that's how the bond market works. It's solely fundamentals. And so when things start to occur, and fundamentally within the markets, yields start to move to compensate for those risks. That's not what happens in the stock market. Stock market is totally speculative. Just I'm buying it because it's going up. Bond market's all fundamentals. That's why paying attention to credit spreads will save your life long term investing in the markets.
Yeah, talk a little bit more about bonds and kind of the risk-free rate, talking about treasuries. As of late, too, I've had a number of folks ask, is there a way to try to predict future performance? Like if they're working with an advisory firm.
Yep.
Sometimes the questions they get, well, if we start working together, can you tell me what my returns will be a year from now? Right? And my answer is, well, your balance will either be higher or lower than it is now. Right? But and that is the question that I get a lot of. Okay, what does the future hold? What is the outlook here?
Your answer should be, right? So I get that question a lot.
Yeah.
This is how I answer. I go, great. Okay, so John, let's play the game.
Okay.
Right? So you be the client, I'll be the advisor.
All right.
Right? And you say, predict for me what my future return will be, right?
Yeah.
Okay.
Well, I'd like to know what if we start together, what would my return be, let's say 2 years from now?
Okay, 2 years from now. Great. All right, tell me what economic growth will be over the next 2 years. What do you think it'll be? 2%, 3%?
Let's say 3%.
3%. Okay. What do you think inflation will be over the next 2 years?
I think we'll be probably heading into a less inflationary environment. So
pick a rate.
I'll say
2%.
I'll say 2%. I'll say 2%.
Okay,
sure.
that's easy math, right?
Yeah.
So now we're at 3% a year on GDP growth, 2% a year on inflation. So all I need now is the dividend yield on the S&P 500, which is roughly actually less than 2, but let's just call it 2, right? So your return, in theory, over the next 2 years is going to be roughly about 4.5%, give or take.
Yeah.
And that's just a function of how markets are going to run. Now, they could be a little bit more, they could be a little bit less, but this is, and when we come back, we'll talk about this is how we structure portfolios. And a very important point to this conversation is the hurdle rate.
Yes.
And so we'll pick up what the hurdle rate is and how to build a portfolio to predict future returns right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So we left off in the last. Before we get to that, real quick, I want to start a petition here on our YouTube. By the way, if you're watching our YouTube channel right now, please hit the like button. We certainly appreciate that. Helps push us out. I want to start a petition that next year we start saving turkeys. Right? We should all switch to brisket because nobody really likes turkey anyway.
I was waiting for this because I was going to ask what's being prepared at the Roberts household.
Well,
is it for the protein? Is it because I was thinking it's not turkey?
No, it's not turkey. It's brisket, sausage, and ribs.
It's fantastic.
Yeah, yeah. Mm-hmm. So and then all the traditional sides. Yeah. We're having stuffing. Funny story. Now I can only tell you this story real quick because I know that the person I'm about to talk about is not listening to the show.
Oh, okay.
So we have a member of our family. It's my wife's father, right? And he's getting up in years, right? So he makes this stuffing every year. Nobody likes the stuffing. It's dry. It's this recipe he's done for 50 years probably.
There's no dry cat food in there, is there?
No. But it's just not good stuffing, right? And nobody likes it. So, but nobody wants to hurt his feelings, right? So there's 30 people at our house. Everybody takes a scoop, puts it on their plate, and then just doesn't eat it. So about 3 years ago, no, longer than that, about 5 years ago, I started making stovetop stuffing and I put it in the back of the oven. Now, the kids all know where this is. It's a secret pot of stovetop stuffing in the back of the stove. And so they all go in, they get their stovetop stuffing. That's what they eat because they like that better for Thanksgiving. But so every year the great debate is what to do about the stuffing.
Is there a family dog hiding underneath the table that you could kind of lean down and is the dog eating pretty well that day?
But here's the funny part about this. So this is a secret. Nobody, he does not know this is going on. And his wife does not know this has been going on for years. It's been years.
I hope she's not listening this morning either.
Yeah, we've had this whole secret organization of stovetop stuffing in the back of the stove. And so there's a family group chat, right? It's a terrible thing. You should never have a family group chat. And so their debate, the family group chat, all the women are on this in the family, and they're all talking about, who's bringing what for Thanksgiving, everything else. And my daughter jumps into the family group chat because she wants to be the adult now. She wants to join the board, right? The committee. So she jumps in and says, well, who's going to tell?
Oh, no.
who's going to make the stovetop stuffing this year? And it exploded.
Those things that we shall not mention.
Yes. So now there's this huge fight. It's like, oh, no. We're having grandpa's stuffing this year.
The stuff that he pulled out of the pillow and put into a casserole dish.
Exactly.
Wink, wink, nudge, nudge.
Yeah. So we'll see how this turns out. But there was a huge meltdown over stuffing yesterday. Anyway, just for the break, talk a little bit about how to predict future returns in the market. And this is always the big challenge. Look, 2 things you should never do, and stop it. Don't worry about past performance. What did your portfolio do over the last 5 years? Who cares? That was 5 years ago. Past performance is no predictor of future results, right? Things happen. Stop worrying about past returns. Focus on what you need to generate in your portfolio. Stop worrying about what the market might do in the future. You don't know. I don't know. John doesn't know. Nobody freaking knows what's going to happen next month, much less next year. I just wrote an article about Ed Yardini saying, we're going to hit 10,000 on the S&P by 2030. Maybe. But he's been dead wrong before, because in 1998, he said the S&P is going to 5,000 and kind of missed the dot-com crash. Did the same thing going into 2008. Making these linear predictions about markets are great as long as markets keep going up. So stop that. Quit it. It has nothing to do with anything. Now, if the market does go up a lot, great. You get to exceed your goal. But this is why John and everybody else, all of our advisors sit down, they establish a hurdle rate. They say, what do you need to reach your goal?
Yep.
Do you need 4%? Do you need 5%? What's that number? So let's just say, John, give me a hurdle rate. Pick a number, any number, whatever number you want.
We'll say 4.5%. 4.5%.
Can you make it round?
Okay, we'll say 5%. Sorry about that. I got stuffing on my mind. 5%.
5%. Okay, so John wants to build a 5% portfolio. So keep it real simple. I've gone through this math with you before. Let's go buy some Treasury bonds at 4%.
Okay.
Right? So 50% of the portfolios, and I'm just throwing out numbers and percentages, just easy math. Let's go buy 50% of the portfolio in Treasury bonds yielding 4%. So out of my 5% I need to generate every year, I've already got 2% done. Right? So 50% of 4% is 2%. So there's 2% in the bank. I'm going to get 2% regardless of anything. That's just going to come in. I'm going to put 50% of the portfolio into the S&P 500. And it yields less than 2% right now, but let's just say it's 2%. Again, easy math, right? So if I have 50% of my portfolio in the S&P 500, that's a 1% dividend yield out of 2. 50% of 2 is 1. So there's 3% of my 5% already guaranteed. I'm going to get that money regardless of anything else. Now, if I do a little bit of just decent stock selection, so we have a dividend equity model that we run on simplevisor.com. It runs nearly a 4% yield. So with a little bit of stock selection, I could bring that yield closer to 4 right now. So there's 2%. So 50% of the dividend equity model is 2% yield. So there's 4% right there of my 5% that John wants. So all I need is a 2% return in the market to generate that extra 1% growth. That's not real hard to do. And I'm going to do that more often than not. And even if the market declines, I'm still going to generate 4% of my 5. So I'm real close to generating my hurdle rate every year. But see, the problem is that for, everybody's like, well, what's the market going to do next year? Who cares?
Yeah, well, the market's up 26% this year. What do you mean my hurdle rate's 5?
But there's the other point about this. If I build the portfolio right, the market goes up.
Mm-hmm.
Terrific. So now I generated market's up 24, let's say 20%. Easy numbers again. Market goes up 20%. I've got 50% of my portfolio in the S&P 500. So there's 10% on top of my 4. So now I'm at 14% for the year. Yeah, I didn't get 24% for the year, but I got 14. So now I've already generated 3 years worth of gains in my portfolio for what I needed for my target goal. So that's where we go back and say, okay, let's take some of that money and let's harvest that and fund and pre-fund some goals that you wanted to do.
Or maybe you refill up that cash bucket a little bit where you're, because you're managing this portfolio. Yes, there's fixed income instruments in there providing yield. Providing dividend, providing interest. My goodness, it's still stuffing on the mind. I can't help it. But then you've got the growth component too. You're looking at this from a total return standpoint. So as there's interest, dividends, there's gains. Take those. Take that cash, pick the fruit off the tree, and refill the cash bucket that's generating that paycheck that's being sent to you on a regular basis, whether that's once a month, every 2 weeks, once a quarter, however you need it for a budgeting standpoint, right?
That's right.
And that's so important. That's why we tie all this together with those financial plans to figure out, okay, regardless of what the market does, and yes, we all pay very close attention to what the markets are doing. But at the end of the day, you really need to focus on what is the rate of return that you need moving forward to support your lifestyle. Keep your purchasing power, fight inflation, fight taxes, do all the things that you and your significant other, you and your family want to do. And at the end of the day, how much risk do you need to take to achieve that, right? So yeah, it's great that the Standard & Poor's 500 index is up, close to 27% this year. Well, in 2022, it was down 18%. Right. So you got to think about all this. What is the amount of risk that you really need to take to achieve that hurdle rate over time? So if you've kind of won the race, or if your dollars are at what I like to call critical mass, you just want to make sure that your money is participating in the market when markets do well, like Lance mentioned. You're going to earn above that hurdle rate. You may not be up, you're not going to be up 27% this year, but you're still going to participate very, very well, so that way you can keep and maintain your lifestyle. But if for some reason, if the markets do get more volatile, or if the bottom falls out, you're not going to get derailed.
Yeah. And Larry asked, he says, could I do the math on 4.73295% return, which means I would need 59.161875% in stocks.
There you go.
Larry, go eat your turkey.
We even send you some stuffing with that too. But
you can't beat me, Larry. You can't beat me.
A lot of love. Feeling a lot of Thanksgiving love this morning.
Exactly.
Here in the studio. Yes.
I did set my scale back 10 pounds this morning for Thanksgiving.
You did?
Yep. Thanksgiving daylight savings time.
I like that.
Yeah.
I see. I'm a kind of a protein guy myself, but like Thanksgiving's that time of year. It's like bring on the potatoes, bring on the green bean casserole, bring on the stuffing, bring on the sweet potatoes.
So what do you cook?
Well, we're going to take a side this year. I'm not even sure what that is yet, but my wife's family typically makes a turkey. They have like a baked turkey, and then they have a fried turkey.
Right. So somebody's setting their house on fire.
Yeah, they're taking it for the team, for the rest of us.
I like that. I like that idea. Yeah, people, if you're going to fry a turkey, do not throw a frozen turkey into a deep fryer.
Yeah, we don't want to see you on YouTube.
Yeah, exactly. Thaw it out first. Then throw it in and run like hell. All right, hey, thanks for joining the show today. We'll be back on Monday. We appreciate y'all being here. Please smash that like button for us for Thanksgiving. We certainly appreciate it very much. Y'all have a very happy, safe Thanksgiving. Enjoy your family. We'll see you back here on Monday for the next live show. But don't forget, we'll have podcasts for you for the next 3 days as well, just to keep you entertained through the holidays. Some of our best compilations over the next 3 days about markets, money, and you, of course, as always. Happy Thanksgiving. We'll see you next week.